Hello everyone, I'm Patrick Fross and welcome to our market update video for the week of April 27th, 2026. We are here to be the voice of clarity and reason in a world full of the pundits of pessimism and the constant news headlines of fear and worry. Over the past several weeks, we've been talking a lot about geopolitical risk, especially the ongoing tensions involving Iran and how markets initially reacted. But here's the interesting part. Since March 30th, the market has staged a pretty strong recovery. The S&P 500 is up about 13%, and the NASDAQ has surged nearly 20%. So the big question is, why are markets going up when the situation overseas still isn't fully resolved? Well, what we saw early on was actually very typical. When a geopolitical event breaks out, markets tend to follow a familiar playbook. Uncertainty spikes, investors pull back, and stocks sell off. That initial reaction isn't necessarily about fundamentals. It's about fear of the unknown, the uncertainty. Concerns around oil supply disruption, shipping lanes like the Straits of Hormuz, and the potential for escalation all contributed to that early volatility. But then something interesting happens over time. Markets begin to adjust. Investors start to process the information. And unless the situation significantly escalates, you often see what I'd call a numbing effect. In other words, the headlines don't carry the same shock value they did at the beginning. In this case, while tensions are still present, major hostilities have eased or at least paused. And global efforts to contain the situation, like the naval presence and partial stabilization of shipping routes, have helped reduce worst-case fears. So investors begin to look past the immediate uncertainty and start asking what really matters for the market going forward. And that brings us back to fundamentals, which ultimately is what drives markets over time. Corporate earnings have been stronger than expected. Current projections suggest earnings growth for the S&P 500 could come in around 8 to 10% this year, with expectations of 10 to 12% growth next year. And that's meaningful. At the same time, inflation has been gradually cooling, and while the Federal Reserve has kept interest rates steady for now, the market is increasingly pricing in potential rate cuts later this year. Lower rates combined with solid earnings growth creates a supportive backdrop for equities. Another key factor is time horizon. Most investors aren't focused on the next 30 days. They're looking out 3 to 5 years. And when you take that longer term view, the assumption is that today's geopolitical issues, including the situation with Iran, will eventually be resolved or at least stabilized. So instead of reacting to every headline, investors are asking, where will earnings be in a few years? What will interest rates look like? And how will the global economy grow from here? Right now, the answers to those questions are generally supportive of higher equity prices. We're also seeing continued strength in key areas of the market, particularly in technology and AI-driven companies, which have been major contributors to the NASDAQ's outperformance. At the same time, economic data in the U.S. has remained relatively resilient, with steady job growth and consumer spending holding up better than many expected. All of this reinforces the idea that despite geopolitical noise, the underlying economy is still on solid footing. So while it may seem counterintuitive that markets are rising during an unresolved global conflict, history shows us that this isn't unusual. Markets react quickly to uncertainty, but then they also adapt quickly once that uncertainty becomes better understood. And right now the story has shifted from fear back to fundamentals. As always, we'll continue to monitor both the geopolitical landscape and the economic data. But for now, that's what's driving this recovery, fundamentals. Thank you for watching and have a wonderful week.